Something extraordinary is happening in silver markets right now, and the mainstream financial media is barely covering it. While you are celebrating the new year, silver crossed $90 per ounce for the first time in history. But that's not even the real story. The real story is what's happening beneath the surface. Physical silver in Dubai is selling for $99 per ounce. In Japan, premiums hit 60% over spot price. In Shanghai, buyers are paying 12 to 13% premiums just to secure metal. Smash that like button. Drop your analysis in the comments and subscribe, because what unfolding in silver markets right now will be discussed for decades. This isn't speculation. This isn't hype. This is a systematic breakdown of the pricing mechanism that has governed silver for over 40 years. And when I show you what happened on January 1st, 2026, when China's new export controls took effect, you'll understand why some analysts are now calling this the Great Silver Squeeze. Silver opened 2025 at $28.92 per ounce. 12 months later, it crossed $81. That represents a 147% gain in a single year, making silver the best performing asset of 2025. Not Bitcoin, not tech stocks, not gold, silver. But here's what makes this different from every other commodity rally you've ever witnessed. This surge isn't being driven by speculative money. COMEX open interest remains unusually low for a market making new all-time highs. When gold and silver typically rally, fast money piles in. Speculators flood the futures market. Open interest expands dramatically. That's not happening. Gold's open interest sits near 420,000 contracts, levels you'd expect during market exhaustion, not during an explosive uptrend. So if speculators aren't driving this, what is? The answer is physical demand. Industrial users, sovereign nations, and investors who want actual metal in hand, not paper promises. And that demand is colliding with a supply situation that's becoming impossible to ignore. Now here's where it gets really interesting, because what China just did on January 1st fundamentally altered global silver supply dynamics. On January 1st, 2026, China implemented new silver export controls that replace a quota system in place since 2000 under the new licensing framework. Only firms that can prove they executed silver exports annually from 2022 through 2024 qualify for licenses. New applicants must demonstrate annual production exceeding 80 tons plus consistent export records. Only 44 companies received approval to export silver under the new framework for 2026 and 2027. This isn't a complete ban, but it's as close as you can get without calling it one. Elon Musk responded on social media saying, "This is not good. Silver is needed in many industrial processes." Why does this matter so dramatically? Because China controls approximately 60 to 70% of global silver refining capacity. Even though China is a net importer when you account for both refined silver and silver ores combined, their refining infrastructure makes them the gatekeeper for new mined silver worldwide. This move mirrors China's rare earth export control strategy: designate a resource as strategic, implement licensing requirements, tighten the spigot gradually, use supply as geopolitical leverage. The difference with silver is its dual role as both an industrial metal and a monetary asset. That makes the control more powerful and the implications more severe. The timing couldn't be worse for global markets. The silver market has posted structural deficits for 5 consecutive years. Total demand in 25 reached approximately 1.24 billion ounces. Total supply, including mine production and recycling, only amounted to about 1.01 billion ounces. That's a 230 million ounce annual deficit. Those deficits have been quietly draining inventories worldwide. COMEX registered inventories in the United States are down nearly 70% since 2020. London Bullion Market Association vaults have lost around 40% of their holdings. Shanghai inventories have fallen to their lowest level in a decade. Smash that like button if this is connecting the dots. And make sure you're subscribed, because the backwardation signal I'm about to explain hasn't appeared at this level since 1980. Silver futures just entered the deepest backwardation since 1980. The front month contract is trading approximately $2.88 higher than later contracts. That might sound like a technical detail, but it's one of the most important signals in commodity markets. Let me explain what this means. Normally, futures prices sit above spot prices. That's called contango. It makes sense because holding silver isn't free. You pay storage, insurance, financing. Futures prices build in those costs. Backwardation flips that relationship completely. It happens when futures prices fall below spot prices. A clear sign that buyers are desperate to get silver now rather than waiting for future delivery. Think of it like paying extra for same-day delivery because you can't afford to wait. The last time backwardation exceeded $2 was January 1980. What followed was explosive. Silver gapped up 32%, jumping from $28 to $37.75. It then continued climbing to $48, posting a 71% rally in just 1 month. A similar episode unfolded in early 2011. Between February and April, silver's futures curve briefly flipped into backwardation. Heavy ETF inflows and surging investor demand for hard assets pushed the market to the brink. Silver rallied from around $27 to nearly $50 in a matter of weeks. But there's something even more concerning happening right now. Silver lease rates have exploded to approximately 8%. In years of ample supply, 1-month silver lease rates typically sit around 0.3 to 0.5%. By January 2026, this rate had reached 8%. Why does this matter? Because lease rates tell you how desperate the market is for physical metal. When someone is willing to pay 8% annualized just to borrow silver so they can ensure delivery on time, that's a blinding signal that physical supply and demand are severely out of balance. The gap between paper prices and physical premiums has reached levels never before seen in modern markets. On January 1st, 2026, while COMEX silver futures showed $72 per ounce, physical bullion dealers in Japan and UAE were selling silver when they could find inventory at $130 per ounce. Let me repeat that. An 80% premium for physical silver over the official spot price. This has never happened before in modern markets. Gold occasionally sees 5 to 10% premiums during supply crunches. Silver sometimes trades at modest premiums in specific markets, but an 80% systematic decoupling between paper and physical prices across an entire region? Unprecedented. In Shanghai, physical silver premiums exceeded $8 per ounce above COMEX prices throughout late December. Buyers in China offered foreign suppliers $8 premiums to secure metal. Indian buyers offered $5 premiums. In Dubai, the lowest price for a 1-ounce silver coin reached $99.93, while COMEX March contracts closed at $72.26. This isn't a temporary dislocation. This is a credibility crisis for paper silver markets. For decades, global silver price discovery was controlled by futures traders on COMEX and the London Bullion Market Association. Trading volumes in paper silver dwarfed the total stock of above-ground silver. At one point, the notional ratio reached as high as 356 to 1. Drop a comment with whether you think paper markets can survive this stress, and subscribe for ongoing coverage, because the delivery data I'm about to share reveals just how severe the physical squeeze has become. Between early and mid-January, in just 7 days, 33.45 million ounces of silver were physically withdrawn for delivery from COMEX. That represents roughly 26% of COMEX's registered inventory disappearing in a single week. The December delivery data shows similar stress. In just 2 days of the December delivery month, there were 23,970 gold contracts standing for delivery, representing 2.397 million ounces, plus 8,350 silver contracts, or 41.525 million troy ounces issued and stopped. What makes this particularly striking is that November isn't normally a heavy delivery month. Yet November saw just under 20 million ounces of silver and 1.267 million ounces of gold delivered. Off months aren't supposed to behave that way. Since October 1st, approximately 90 million ounces have been delivered off COMEX. The pace is accelerating at a level most market participants don't fully comprehend. One analyst described it perfectly using a cookie box analogy. For years, everyone assumed the box was full of cookies. There's a picture of cookies on the outside. People traded based on that assumption. Now people are opening the box, reaching inside, and discovering it's nearly empty. When participants realize the box contains far fewer actual cookies than the paper claims suggested, the pretend cookie trading game falls apart. Real cookies, physical gold and silver, become substantially more valuable. The Silver Institute projects 2025 will mark the 5th consecutive year of significant market deficit. Global silver demand is expected to remain broadly stable at 1.2 billion ounces. Industrial fabrication is forecast to grow 3%, with volumes on track to surpass 700 million ounces for the first time. Silver industrial demand continues benefiting from structural gains in green economy applications. Despite potential pressure on US renewable energy projects, global photovoltaic installations are expected to achieve another all-time high in 2026. In the automotive industry, even assuming slower growth in battery electric vehicle production, greater vehicle sophistication and electrification of powertrains will boost silver demand. Artificial intelligence infrastructure and data centers are emerging as a new demand vector, using silver in high-efficiency electrical components, precision contacts, and thermal management systems designed to handle extreme power loads. Industrial demand represents over half of total silver consumption for the second consecutive year. On the supply side, silver mine production is expected to reach a 7-year high in 2025, rising 2% to 844 million ounces. But that increase doesn't come close to meeting the demand surge. The structural deficit persists and appears to be widening. Smash that like button one more time if you're realizing how significant this supply-demand imbalance really is, and make sure you're subscribed for updates as this situation develops. Governments worldwide are treating silver like a strategic asset. The United States officially added silver to its list of critical minerals for the first time ever in 2025. Russia confirmed it's allocating funds to purchase silver for its reserves. China tightened export controls, citing silver's strategic importance for clean energy and defense. The message is absolutely clear. Nations want silver within their borders, and they're willing to compete for it. This sovereign demand is putting additional pressure on an already tight market. When countries start competing with industrial users and investors for the same limited supply, the repricing can be dramatic. Market analysts are revising their targets upward as the structural reality becomes impossible to ignore. Some prominent voices now see silver reaching $175 or higher in 2026. That would represent another 140% gain from current levels. One technical analyst quoted a measured target of $400 per ounce based on a multi-decade cup and handle formation. While that sounds extreme, the physical demand dynamic driving the market today makes it less implausible than it might initially appear. The gold-silver ratio currently sits around 68 after peaking near 104 in April. Some analysts project this ratio falling to 15, which would imply dramatically higher silver prices relative to gold. If gold continues toward $5,000 per ounce, as several major institutions now forecast, and silver reaches even conservative historical ratios, the mathematics produce striking numbers. If this breakdown helped you understand what's really happening in silver markets, smash that like button one final time, share this with anyone tracking precious metals, and subscribe for continued coverage of what may be the most significant precious metals repricing event in modern history. The Great Silver Squeeze of 2026 is underway. The question isn't whether repricing will occur. The question is how dramatic that repricing will be when physical reality can no longer be reconciled with paper promises. Stay informed, stay focused, and pay attention to what markets are actually doing rather than what conventional wisdom suggests they should do. This is a historic moment. The silver market is fundamentally changing, and nothing will ever be the same.